The Bank of Zambia, through the Monetary Policy Committee, has yet again increased the monetary policy rate by 1%, bringing it to 13.5%. My name is Nathan, and welcome to the FinLab. So yes, the benchmark interest rate has been raised from 12.5% to 13.5%. This was announced by the Bank of Zambia Governor, Dr. Denny Kalelia, in today's MPC media briefing. So inflation has continued to drift away from its target band of 6 to 8%, currently sitting at 13.8%. So the factors that prompted the increase in the monetary policy rate include the persistent depreciation of the kwacha against major trading currencies, as well as escalating prices of essential food items such as maize grain, maize products, vegetables, alongside rising energy costs. Furthermore, the ongoing drought, which has led to the declaration of a national disaster by the president due to insufficient rainfall, has posed a significant threat to agricultural output and food security, therefore amplifying inflationary pressures through increased food prices. And also, Zambia's recent restructuring of its Eurobond debt reflects the country's precarious fiscal situation. The central bank's decision to raise interest rates may be aimed at restoring investor confidence and also demonstrating a commitment to fiscal discipline, which could support debt sustainability efforts in the long run, right? So what do we expect the implications of this decision to be both in the short term and in the long term? In the short term, interest rates will shoot up immediately, meaning banks will raise their interest rates on all existing and new kwacha-denominated loans, right? This means that borrowing and spending by individuals and businesses will reduce, therefore slowing down economic activity. Over the long term, however, higher interest rates may help moderate inflationary pressures by reducing aggregate demand and inflation expectations. Additionally, liquidity is expected to tighten, leading to a reduction in the circulation of money. So while this may initially dampen investments, particularly in the short term, it could encourage savings and investments in financial instruments over time, potentially fostering long-term economic growth. And also, the increase in interest rates may initially stabilize the kwacha against the USD by attracting foreign investments, but the impact could be temporary, mainly because exchange rates are influenced by a variety of factors, including economic growth, trade balances, and the economy's stability generally. If higher interest rates lead to concerns about economic growth by investors, it could dampen inflation expectations, which might reduce long-term attractiveness of the kwacha despite higher interest rates. So, how does all this impact the regular Zambian? Of course, for the regular Zambian, the cost of living is expected to go up, as this will lead to higher borrowing costs for mortgages, personal loans, business loans, and other forms of credit. But on the other hand, higher interest rates may lead to higher returns on savings, which could benefit those individuals who are looking to save in interest-bearing accounts. So generally, the central bank's action to raise interest rates could also impact consumer confidence and sentiment about the economy, which could influence spending and saving behavior. And lastly, how will this increase in the MPR affect the securities market? So here we're basically talking about treasury bills and government bonds. So the increase in the MPR is likely to lead to higher interest rates on government bonds and treasury bills. This could make these instruments more attractive to investors who are seeking higher returns, potentially leading to increased demand at auctions. But also, higher interest rates on these securities could lead to increased borrowing costs for the government. So this could put pressure on government finances, especially if interest rates rise significantly. So ultimately, the impact on investor demand on government bonds and treasury bills will hinge on how the increase in interest rates influences the overall investor sentiment and risk appetite. Higher interest rates may attract more investors looking for higher returns, but they could also reduce demand if investors become more cautious about the risks associated with government debt. Overall, the effects on government bond and treasury bill auctions will depend on how market participants perceive and respond to the change in monetary policy, as well as broader economic conditions and fiscal policy. Otherwise, this was my short review on the Monetary Policy Committee's decision on the MPR. Says thanks and goodbye.